Fidelity's no-fee index funds. Are they worth it? This is interesting. From Barbara Freiberg, investorplace.com. So let's see what old Barbara's talking about here. This is Dateline February 28, 2019. So a little bit behind your old buddy Josh here. Using its own indexes is just one way the fund giant can afford to offer zero-fee products. Fidelity Investments rocked the investment world last August with its bombshell offer of zero-fee index funds. In the race to the management fee bottom, Fidelity changed the game. But there's more to this move than meets the eye. Fidelity offers 3 zero management expense ratio funds and many zero minimum investment amount funds. Fidelity's no-fee index funds. Fidelity's Zero Large Cap Index targets the return of the large U.S. equity market. It has no minimum investment, unlike the competitor at Vanguard, and it does not charge a fund management fee. It's got the Zero Total Market Index. It seeks to provide with the U.S. total stock market. Also has no minimum investment or fund management fees. The third is the Zero International Index. As with the case, it has zero index management fees or investment minimums. Pretty good so far. All right. It has the typical large cap, Berkshire Hathaway, Johnson & Johnson, Apple, blah, blah, blah. In 2019, as of that writing in February, it was up 11.94, while the S&P 500 was up 11.4. All right, a little bit odd there. But in contrast, FZ Rocks has a much larger range of equities, some 2,500 in its portfolio. And this fund has increased 12.64%. Well, what's the S? Oh, right here. That's the total market. Okay, gotcha. FZILX, the international, was heavy in financial industrial stocks, for those, making up about 32% of it. Top 10 holdings include HSBC, Alibaba, and whatnot. All right, the fund is up 10.5%. Okay, well, let's see, keep reading. It's just common sense that if there's zero management fee, there's no way to make money, or is there? Sometimes the goal isn't solely to make money. Yes, this is exactly what I'm talking about. Fidelity can build a relationship with valuable younger investors who may ultimately invest in other, more lucrative Fidelity funds and products. Richard Thaler and his co-author Cass Sunstein write in Nudge, Improving Decisions About Health, Wealth, and Happiness, about how inertia keeps most people from acting. So once these young investors are in Fidelity's system, it's likely they'll remain. Consider these Fidelity no-fee funds like a lost leader. Exactly. The grocery offers a discount item such as a gallon of milk to get you in the store. And once you're in, it's likely you'll buy other items with higher margins for a net profit for the store. Are Fidelity's zero-fee funds good investment? Well, fees are important, but so is performance. There are a sea of index mimicking large cap U.S. total market, U.S. and international stock funds. Most benchmark their returns against a well-known gauge like the S&P 500. To keep costs down, Fidelity is avoiding the typical licensing fee for the common index fund benchmark. Instead, the firm is creating their own benchmarks, the Fidelity U.S. Total Investable Market Index. That's completely fine with me. But the real question is performance. Vanguard has 4 basis points, or 40 cents annually per thousand invested. We're talking 40 cents, my friends. I mean, it matters not. Fidelity, with their created benchmark Vanguard, it literally matters not. I'm going to say 40 cents a year on $1,000. It literally, stop. Okay, so consider tax consequence. Before you jump into both feet and gobble up these enticing zero-fee index funds, think about the tax consequence. Yeah. If you sell existing, it depends. If returns are comparable or better to similar index funds, then sure, buy in. Just remain aware of the tax implications. All right, that didn't tell me much. All right, so look, at the end of the day, it's a freaking crap. I don't have a coin here. Yeah, I do. So here we go. You ready? How would I choose between Fidelity and Vanguard here? Heads is Vanguard, tails is Fidelity. I would say, and I got tails, so I go with Fidelity. That's literally the decision I make there. However, I still go with Vanguard because Vanguard is owned by the shareholders. Fidelity is owned by the Johnson family. Johnson family is worth $20 billion, $30 billion now, something like that. John Bogle, when he died, had a net worth of like 50, 60 million. So That's all you need to know from my perspective. I'm willing to pay an extra 40 cents. I guess I'm a highfalutin type of guy, willing to pay an extra 40 cents per 1,000, huh? I just, whatever. Either way, it's a crapshoot. Yeah, go with Vanguard, be done with it. All right, we'll see you.